It has been. Abhiram Eleswarapu is with us, head of India Equity at BNP Paribas. Abhiram, good to have you with us here. Thanks for your time. I don't think you have coverage on the defense space, Abhiram, or do you?
No, we don't cover defense. But
I mean, HAL,
I think we did, yeah.
HAL numbers just
We did
came.
discuss this in the past, yeah.
I know,
And
big numbers, big growth. So I don't know if you have thoughts or if you have soft coverage. Any thoughts at all?
less stock specific, but much more on the space. And obviously the numbers are looking good. In fact, I would say that in general, all companies in the capex kind of space, cap goods, etc., all the numbers have been pretty solid this result season. Now, the way we can think about this is that once the elections are over, it's fair to assume that government policy effects of probably all the sectors that we have under coverage, the most in the capex related areas, and much more so in railways, defense, and even power. So I would be long-term positive still on all these areas.
Abhiram, capital goods is the, so defense is one, right? But then you've got all these other names, Siemens and ABB, up 70% this year. CG Power is there, nearly a lakh crore market capitalization. Runway looks pretty solid for each of these businesses. Transformers, railways, power equipment. Of course, I mean, there's a fair bit of ordering which is happening. The problem seems to be on the capacity front for most of them, and they're expanding capacity. But for new investors who are looking to gain exposure, is there a way in this space?
Well, I guess that they really don't have much of a choice. Do you see? I mean, the main issue for them is that stocks have run up a lot. And valuations are obviously not as palatable as they were maybe a year or even 2 years ago. And therefore, you really don't have much choice but to pick stocks at high valuations, as long as you're convinced that there is a 3 to 5 year runway for growth, which I think there is. So I think valuation then becomes a secondary argument once you take that view. And I guess I'm seeing several foreign investors who may have missed the rally on some of these places are still looking to buy these places. So I think that the long-term picture is what is what they're considering much more than anything else.
What's been the overall read on the earnings season so far?
See, when you go by just pure numbers here, then the earnings season was, I would say, neutral for estimates. I don't think at a index level our estimates have changed a whole lot, maybe 1% upgrade in all. But if you compare the earnings season with the previous earnings seasons, I think one of the things that I've kind of noticed is the last 4 earnings seasons were all about margin beats. And this time is actually about some amount of revenue beat as well. So I think that's a positive development. Less so on margins this time. In fact, you may have seen some of the large caps have actually disappointed on margins. But revenue growth is actually a key driver for PE multiples. And to that extent, I think it's more preferred to a margin beat. So I think that's a positive that's come out of these results.
So which are the sectors, themes where we have seen a revenue beat compared to your own estimates?
Well, I think that mostly, again, back to this point that I made, the real beats have really come from capex areas, almost all of them. And the way in a little bit maybe on the IT side, what we saw was a little bit of a cut. On banking, it was mixed. On consumer, in general, we were a little surprised positively, I would say, especially on the consumer staples side. And it does look like maybe that sector is starting to turn around a little bit. So these are the bigger areas. I think we still have some results yet to come, if I'm not mistaken. But data that I saw captured only about 3/4 of all companies so far.
So considering that consumer staples has positively surprised you, would you suggest increasing the allocation to one's portfolio?
Well, I kind of think about it for the next 1 year, maybe not as positive as the market would like to believe, because I still do think that if you take a longer term view on this sector and if it's still going to remain a low to high single digit growth area, then it may not be the best place to be. And that there's several other sectors that offer much higher growth, maybe at higher valuations as well, but that's a different matter. What I would think of, however, is from a shorter term perspective, given that the results are actually not bad, and that we have an event risk ahead of us on the elections, in the near term, I think that staples is not a bad place to be.
Again, the manufacturing theme, but on the EMS side, electronic manufacturing services, we had Dixon management with us in the morning. after the results. You know, FY24 revenues were about just under 18,000 crores. For 25, they're saying should be between 30 and 32,000 crores. Margins are low. Margins are about 4%, but that's the industry margin. Do you have coverage here on this space, and any thoughts?
Actually, just look at the consumer durable space overall. And I think that we're moving from one subsector in that to another. The first, and if you recall, we did speak in the past about air conditioning being an important area because the summer was obviously pretty harsh. And I think from there you move on to the next level, which is fans and lighting and so on and so forth, which are sort of playing out now. And beyond this, I think you move on to the EMS side and cables maybe. And the reason for that is that some of these are actually a play not just on just consumer spending, but also on real estate to some level, and spending on these areas tends to lag real estate pickup by about 1 to 2 years. So in that sense, I'm not surprised with the kind of guidance that some of these companies are coming out with. And broadly, I think investor focus will move away from the more expensive parts of consumer durables to areas such as this.
Although not cheap. I mean, they're also not cheap, I think. Yeah.
Nothing is cheap, right now.
Chemicals, maybe. We had Nimesh Chandan of Bajaj Finserv earlier with us. Abhiram, and I asked him, what's the contrarian bet right now? He said chemicals. Its valuations are built in enough comfort that even if you have to wait, of course, you're not saying indefinitely wait, but within the next 1 year or so, there is potential for these stocks to re-rate. I don't know if you have thoughts here.
Well, actually, chemicals is one place where I really haven't done a whole lot of work on. But if you're asking for a contrarian play, I would say banks. And why not, considering the significant underperformance. And I can sense investor frustration around the sector because it has not done well. And but if you come to think of what may happen post the elections, I had earlier mentioned capex plays, and to fund that capex, you will need capital, and banks are best placed to provide that. Now, I think where investor attention is focused on today is the fact that even the largest banks are not immune to regulatory risk. And I guess once we see off this and beyond the elections, I have a feeling that financials will actually be among the best performing sectors.
Thank you, Abhiram, for joining in. Let's address InfoEdge. The stock is down